Sunday, August 2nd, 2020, Maneco 64, home of alternative economics and contrarian views. Quick video today looking at the Federal Reserve. I think it's an important article in the Wall Street Journal about the Federal Reserve. Billy's here with us as well. He's probably going to lie down right now, but he's at work. Don't worry, he's not skiving. So the article is in the Wall Street Journal. It was published today. It says Fed weighs abandoning preemptive rate moves to curb inflation. I think that's very important. Not that we haven't had inflation in the true sense, of course. The inflation that we're told we have, the CPI or PCE, those are all doctored. We know the purchasing power of the dollar or the British pound here in the UK has been dropping dramatically for the last 20, 30 years. All the statistics are doctored. I recommend people go to shadowstats.com. John Williams does a great job of calculating all these statistics, how they used to be calculated prior to the early 80s when they changed the calculation. So let's get on with this article. I think it's important. It just goes to show how important it is to have tangibles to protect your monetary savings or your wealth. Of course, gold and silver are the top monetary hedges for currency debasement, and that's the policy that the Fed's going to follow. It says Fed weighs, so it doesn't mean that they're going to do it, but just the fact that they're talking about it, I think, is important. So central bankers look to change long-running strategy to encourage lower rates, shift unemployment, inflation dynamic. So let's go through this article. It was written by Nick Timmy Rouse from Wall Street Journal. All right. Federal Reserve is preparing to effectively abandon its strategy of preemptively lifting interest rates to head off higher inflation, a practice it has followed for more than 3 decades. Well, I'm not surprised. The last press conference last week of the FOMC, Jay Powell was asked about if they're thinking about raising rates, and he said, I'm going to repeat again, I said this a few weeks before, we're not even thinking of raising interest rates. So this is not surprising. Instead, Fed officials would take a more relaxed view by allowing for periods in which inflation would run slightly above the central bank's 2% target to make up for past episodes in which inflation ran below the target. It would be a significant change in terms of how they are thinking about the trade-off between employment and inflation, said Jan Hatzius of Goldman Sachs. A lot of those things look very different now from the way they looked a few years ago, he said. Fed Chairman Jerome Powell hinted at the shift at a news conference last week when he said the central bank would soon conclude a comprehensive review of its policy-making strategy that began last year. Mr. Powell initiated the review with an eye toward beefing up the Fed's ability to counteract downturns in a world where interest rates are lower and more likely to remain pinned at zero. The reason interest rates are low like that and pinned at zero is because the Federal Reserve itself is manipulating the bond market by buying bonds, by telling investors, hedge funds, speculators, that they're going to keep rates low. If they allow the market to set interest rates wouldn't be this low, and we'd get inflation back. So basically the Fed wants to, well, the inflation in their terms, of course, this just means the Fed wants its cake and it wants to eat it too. Even before the severe shock from the pandemic, the Fed had grown concerned about spells of low inflation that have bedeviled authorities in Japan over the past 2 decades and in Europe for the past decade. I'm not sure how low inflation is a bad thing. They're saying that it's bedeviled authorities. I mean, deflation is really good. It makes things cheaper, right? Well, for them, it's not good. I can explain it to you why. Because they're trying to keep this debt bubble going, this fiat currency debt bubble that's been inflating since Nixon took the system off gold standard. And the only way for them to keep it going is to basically pretend there's a problem with low inflation so they can keep actually inflating with more easy credit. Anyway, let's keep going. The change being contemplated now is a way of essentially telling markets that rates will stay low for a very long time. Markets have likely already picked up on this change given the continued declines in longer term interest rates. Yet we noticed this week that the 10-year yield dropped below a key support level at 0.6. The 2-year note as well dropped below 0.15. The changes on their own will do little to provide more support to the economy right now because investors already understand that the Fed isn't likely to raise interest rates for years, says Stephen Blitz, chief U.S. economist at research firm T.S. Lombard. It is a change at this point without meaning. It is just words, he said. Well, I think they're trying desperately to inflate the debt away. That's what they're doing. Is it any wonder that gold closed at an all-time high on Friday, the highest monthly closing ever, about $150 above the 2011 close at 1825. We closed at 1975. I don't think so. Is it any wonder that silver's starting to liven up? The Fed would formally adopt changes by altering a statement of long-run goals that it approves annually, something it last did in January 2019. The changes we'll make are really codifying the way we're already acting with our policies, Mr. Powell said last week. One way for the Fed to do that would be to amend that document to say inflation should average 2% over time. The virus shock led the Fed in March to rapidly slash short-term rates to zero, purchase trillions of dollars in government-backed debt, and deploy an array of programs to backstop lending markets. While a lot of you know, of course, that this financial crisis started last September in the repo market. This crisis, engineered crisis, as I've said many times, has only been a cover for the central banks to bail out the system again when everyone's focusing on the health crisis. They're doing 2008, 2009, like in spades. Because of the pandemic, Mr. Powell tabled discussions this spring over the framework review. The Fed resumed those discussions at their 2-day summit last week and could seek to conclude them as soon as their September 15th 16 meeting. That's the next meeting now, mid-September. The Fed formally adopted the 2% inflation goal, a level it regards as consistent with healthy economic growth in 2012. How can that be healthy? The currency that people are supposed to use is debased every year by 2%. That's a 2% tax, right? But central bankers, economists, and investors still expected those rates to return to more normal levels of 4% or so once the economic expansion matured. Well, they did try to normalize rates a couple of years ago, but that failed massively. They had to reverse everything. They can't ever go back to normal. That's why you need to have precious metals. Let's continue here. Even before the pandemic hit, those rates were stuck at much lower levels than 4% for reasons that weren't expected to change soon, such as demographics, globalization, technology, and other forces that have held down inflation. I think that's a load of rubbish. It's the central banks that have held interest rates low. Italian, Greek, Spanish rates were going towards 10% in 2012. What did the ECB do? Well, Mario Draghi said he was going to do everything it took to bring rates down. They started printing money and buying through QE. This is just very deceptive. They keep going on about this. And this guy who wrote this for the Wall Street Journal, he plays along. He's not a real analyst or reporter in my book. The Fed justified preemptive rate increases because monetary policy works with a lag. Now you're saying, yes, there may be lags behind, but we're okay with an inflation overshoot because inflation has run so much below, said Priya Misra, an interest rate strategist at TD Securities. So basically they're saying we couldn't get inflation to 2%. So now we're going to let it really run at 3, 4, 5 because you people deserve a bigger tax on your currency. The Fed says its current 2% inflation target is symmetric, meaning officials are as uncomfortable with inflation somewhat below or somewhat above that level. In other words, 2% isn't a ceiling. In addition, the Fed, under this approach, is always aiming for 2%, and it doesn't take into account previous deviations. The problem for some officials is that the results have been symmetric. Inflation has run at or under the target, but never above it. Well, I would say that is great. That's great for consumers. The Fed's misses on inflation over the past 5 years were relatively small, but some officials were concerned because if the Fed can't meet its target after a long time, consumers and businesses would expect even lower inflation. I don't see the problem. I would love for things not to go up as quickly as they're going right now in price. Such expectations can become self-fulfilling, and officials would be alarmed if they were falling because of the important role expectations play in determining actual prices. In speeches over the past year, Fed Governor Leo Brainard has called for shedding the current approach and taking up a way to make up for past misses of the target. So this Fed governor is not happy with the fact that their measurement of inflation has been so low for so many years that they want higher levels. Wake up, people. The Federal Reserve is they're not your friends, these people. Last month, Ms. Brainard approvingly cited research that would have the Fed refrain from raising rates until inflation reached 2%, rather than initiating rate increases before achieving the target on the basis of a forecast of higher inflation, as the Fed did in 2015. Other Fed officials have signaled more comfort with overshooting the inflation target in recent weeks. In an interview last month, Philadelphia Fed President Patrick Harker said he would prefer to hold rates at low levels, and I quote him, until we see a substantial move in inflation to our 2% target, with inflation ideally overshooting a bit. Any changes the Fed makes would coincide with a deeper emphasis on the benefits of very low levels of unemployment. For years, officials were concerned that allowing unemployment to fall too low could generate undesirable levels of inflation, which occurred after the 1960s. That's another fallacy. Inflation is a purely monetary phenomenon. Low unemployment doesn't cause inflation. Just realize how that doesn't make sense. If more people are working and producing things or servicing people, there's more supply of services and goods. How could that cause inflation? I don't know. In the most recent expansion, however, officials were surprised to find unemployment falling to levels associated with higher prices, but without the anticipated inflation. By raising rates based on a forecast of higher inflation, the Fed risks short-circuiting a labor market expansion when many of the most disadvantaged workers are finally getting jobs or raises. That can be costly if inflation doesn't materialize, said Atlanta Fed President Raphael Bostich on Twitter last month. This isn't inflation for inflation's sake, said Bostich, Mr. Bostich. The changes under consideration would be very meaningful because it would be memorializing their commitment to working toward a tighter labor market when the economic circumstances allow for it, said Representative Denny Heck, Democrat, Washington, who is on the House Financial Services Committee. It would be a huge break from the past. So there you go. It's not going to get any better for the general public in terms of inflation, in terms of the debasement of the currency. And basically, debasement of the currency means higher prices. Your dollars will buy a lot less. But for some reason, the central bankers and mainstream economists think that's a good thing. So the only thing we can do is to know how deceptive the central bankers are, especially at the Federal Reserve, and try to keep protecting our savings from this process of inflation. Because what they tell us is inflation is not really inflation. It's just a phony measure of prices. Inflation, as Felix Sommery, a famous banker in Europe in the early 1900s, said, is purely a monetary phenomenon. It's got nothing to do with high employment or anything else. There you go. I thought you guys would like this heads up about the Federal Reserve and their policies. If you did, please hit the like button. Please share this video far and wide, and think about subscribing to the channel if you haven't yet. And you can also follow me on Twitter, Facebook, and all these other platforms below here. I wish you all a great rest of the weekend, and I'll talk to you later on tonight for my live stream at 9 p.m. London, 4 p.m. Eastern Time. Take care.